You know, we've all heard of the bait and switch, and that's where you buy one thing, turns out that it's something else. And markets, they actually have the same thing, and they're actually called bull traps, and a bear trap is the opposite. So here's how it plays out. A market will start to break out to higher prices over an obvious resistance level, right? Or it's moving with strong momentum. And traders that don't want to be left behind, they buy into the stock, the currency, or the futures, whatever the market is. Price will then flip to the downside, and then it will start to trigger stop losses for traders that have tight stops, right? And then buyers that are holding on, they start to run for the exits. And that selling is fueled, and the traders who have recognized the bull trap was there, they began to sell early. They seek some quick profits. So why do they work? Why do they happen? One word: expectations. So a trader will see that their expectations of higher prices are not met. So they're going to sell out, which causes the market to drop lower. Those that had recognized that bull trap was already setting up, well, they're already selling. And they're having their positions move quickly into profits from all the buyers that are unloading. And we can see a bull trap after price has been in a range and starts to move out to the upside. After a large move to the downside, price will begin to move up. And then it will trap traders long when it heads back down. And then you'll get large momentum moves to the upside, causing traders who fear missing out on that move to jump in. And then it flips, forces them out. And for any buyer that's still hanging on, they're going to see their stop loss hit, and that's just going to cause a further cascading of prices. And then what happens is the bull trap will actually demoralize traders, especially the new traders, and will often result in a trader that's looking to get even with the market. So learning how to identify, to avoid, and even profit from them, that's what we're going to talk about here. So let's talk about identifying it. And honestly, it's not always easy to separate a true move from a potential bull trap. But there are some things from a technical perspective that can help you minimize the chance of getting hit by one. But one thing I want you to remember, a bull trap is not a false breakout signal. I don't like the word false. Why? Well, did price break out? Yes, it did. Well, there's nothing false about that. Did the breakout then fail to continue? Yes. So when that happens, you just basically go from a breakout trading mode into a pullback trading mode, because price is actually doing what? It's actually pulling back. So let's take a look at common price moves that can result in bull traps. Now, the first example is price gapping over a previous swing high. So buyers will send it higher only to see it crash over the next several days. And the size of those candles shows that trapped buyers are hitting the exits hard over the next few days. In the second example, traders get excited because they see that momentum push over resistance. Well, a slight pause is normal after a breakout, but price has no intention of moving higher. The trap is sprung. So in these two daily time frame examples, what do you notice? Well, the moves appear to show strong upside price action, and they're pretty enticing to trade. So imagine if this was an intraday time frame, what that would look like. Also note that the breakout did happen. It rolled over, and then what do you get? A pullback that you can actually trade. And sometimes the traps are not as obvious. So if we look at this chart here, we actually have a successful breakout. It's moving. So the day after the breakout, buying increases as more traders see a successful breakout, and they look to make big gains on it. The next 2 days, we see pullbacks in price, which gives some late buyers a chance to enter. So traders that were in early, they're already starting to take profits. So after those 2 days of pullbacks, those small candles with the lower shadows, those that were late to the party, they're not going to miss the move, right? So that's what they think. Then we get an inside day candlestick pattern. Price begins to break down. Finally, at the end of all this, traders who held on that were hoping for a reversal, they get dealt almost a 2% drop in one day. And that's pretty painful for any trader. So how can you avoid getting stuck in a bull trap? Look, you're not going to be able to avoid all traps, just why you can't avoid all losses in trading. But you can be on the lookout for signs that one might come. So whether you're an active trader, or you're an investor, you should have a trading plan that can help you stay away from these potentially costly moves. And there are ways to do this through indicators, price action, and learning to take profits when your expected price move is under threat. So the first way is to avoid trading range breakouts. How? Look for accumulation. Now, breakouts from a trading range are when a lot of traps get set. And while I say avoid trading the breakout, there is a way to be involved in a trade before the break. So this way, when that bull trap gets set, if there's one, you are already in profit. How do you do that? You look for accumulation under the resistance area instead of playing the actual breakout. And I've covered this price action strategy, and the link is up here to the right. You can check that out. So in this example, price is making higher highs and lows, which is a structure uptrend. Prices started to base, which means just go sideways under resistance. And it's in the upper 50% area of the range. That's a good thing. So whatever tools and techniques you have to find an entry. You can even use mini trend lines that break as an entry. Also, be on alert for any break of highs that begins with momentum off the bottom of a range or in retraced price action. Now, by entering prior to the rush of traders on the break, you can at least pull out a tiny profit as price turns back to knock out those other buyers. You want to stay away from big moves. And what this means is just don't buy the highs of large price moves if you want to avoid getting trapped. Now, this does not mean that pullback trades are off limits, but even then, it can be bounced around like this chart shows here. This chart, I zoomed it in here, but if you zoom out, the last several weeks have made a move up, and it almost looks like a straight line. Those types of charts they're just raring to fall back. So from a technical analysis approach, if you used indicators, you would see an RSI reading of 94. You would see price running along and above the upper Keltner channel line. Price is far away from both the 50 EMA and the 100 EMA. Now, markets can stay overbought for a long time. And while not using overbought as a reason to go out of the market or go short, it's a heads up to watch for adverse price action. And that's where you would tighten up your stops, you'd scale out, or just keep trailing your stop up. All right, so once you know that they do exist, you can start to look for the potential of them forming when price movement resembles what we just talked about. Now, this example is one of my favorite plays. And why is that? Because it sets up in the context of a favorable price pattern, but price is in a downtrend. Price movement fails to put in a new low, which means it put in a higher low. Buyers continue to buy up even as the resistance holds. Price is basing under the resistance level. Gaps up, and then price runs 6% from the previous close all the way up. Looks good, right? How do we trade it? The simplest approach to trading this is to put your sell order below the low of the candlestick that broke upwards above the resistance line. And you know you're wrong if price takes out the high, and that's where your stop would go. Maybe throw in a little bit of a buffer there. What about this one here? Price has driven upwards from the bottom of a pullback. I don't like those, which leads to a lower probability of a sustained breakout. Now, this is a 15-minute Forex chart. And upon that breakout, some traders would have dropped to a 3 to 5 minute chart to get an earlier entry to the first candle that closed below the resistance line, as opposed to this big upthrusting white candle. So let's wrap it up with a simple trading strategy that can actually increase the probability of a successful trade using traders that get stuck in these traps. And I'm going to use crude oil futures. It's going to be a day trading chart for this example, but it doesn't matter what instrument it is. It applies to all of them. First, though, I want a condition that can lead to a bull trap. So with that, I can look for price ranging and an explosion of momentum from the bottom of a range. It's one of them. Overbought condition using RSI or Keltner. Strong momentum in price. So once I have that, then I can add some technical factors to it. At number 1, we have momentum push into a tight trading range just under the highs of resistance. Number 2, using a 14-period RSI, we're in overbought territory, and by itself, that is not a signal to short. That blue splash with the arrow, that's actually a legitimate signal to buy, because price broke lower than the initial range and then was bought back up. Call that a failure test. And that actually fulfills the requirements to trade a pre-breakout move that we just talked about earlier. At number 3, price breaks out of the range, makes new highs. And if you're using volume to show strength, this breakout had a higher volume reading than the momentum move over at number 1. Also note that if you got in at that blue splash, you are in profits right now. Number 4, if you're using RSI for divergence, price made a new high, the indicator is trending down. At number 5, this would be an entry short. And if you were long out of this range at that blue splash, you should be getting out right about here. Short trades could use the price target of the bottom of the range or look to target the base of that momentum candle over at number 1. Your stop loss can be the high of the reversal, an ATR setting. You can trail your stop using a moving average or the highs of candlesticks. Whole bunch of different ways to do that. So wrapping up, bull traps, in my opinion, are a viable trading approach, as price discovery is an absolute in trading. It happens. These traps will take advantage of traders, that fear of missing out, and they are powered by these traders hitting the exits, which can then be exploited by knowledgeable traders. Yes, some breakouts just take off and they go, which is why knowing how to approach a breakout style of trading, as we did talk about, is pretty important. If you're trading the trap and price reverses against you, you may not have to wait for your stop to get hit, because if you can read price action, that can help you get out earlier, but it's vital regardless just to get out. And if the breakout has a successful run, you don't want to be holding on or hoping for a price to reverse in your favor because you shorted the trap. All right, thanks for watching. Any comments, questions, pop them in the comments below. Like and subscribe.